Hello, everyone. Friday was definitely a very bad session for the stock market in more ways than one, as I believe we're getting a pretty clear indication that the path of least resistance is about to change from up to down. The Dow Jones Industrial Average confirmed itself below the 200-day moving average on Thursday with another very weak session, basically opening near the highs and closing near the lows on above average volume. Clear distribution day. The Dow Jones Industrial Average now joins its brother, the Dow Jones Transportation Average, under a sell signal. If you remember, this one has been under a sell signal since all the way back on May 20th, and it's down 5% since then. However, we've kind of had a weird divergence in the market, one that I haven't seen since the year 2000, where despite this kind of action, the NASDAQ is hitting new highs short term, with the NASDAQ 100, the strongest of the bunch. And like I said, last time I saw that was in 2000. This is not 2000. We didn't have a massive internet bubble leading up into this most recent price move, but while history doesn't always, repeat, it does rhyme. And so we could be having a rhyming history moment here, because right after hitting those V-shaped highs on the NASDAQ 100 by basically just a few stocks like Google, and I can't even remember the other ones that were really holding it up. Amazon, too, just recently, like on Friday. We're starting to roll over here on clear distribution. The last 3 down days for the NASDAQ have been on very heavy volume, well above average, to culminate in a 2.5% loss. So it looks like that this was a fake out breakout on this index, but we still remain under a buy mode in the NASDAQ and NASDAQ 100. But the rest of the indexes, like look at the S&P 500, it's straddled in between its 50 200. It definitely looks like it wants to roll over. Russell 2000, same thing. It's hitting actually new lows. And there's some crazy things to all of this that's happening now, because this is just in about a week and a half. So even a week and a half ago, even though Brett started really weakened, it was last Friday, I still had a lot of nice looking technical patterns in my individual long scans, and our holdings were looking fantastic. As each day went on this week, my scans with the BOP green BOP for 20 days or the max green BOP for 5 days, those scans started to get extremely thin, and by the end of the week, there's barely any stocks in them anymore. Let's see how many are even left under this. So now there's under 100 stocks in this, which by last Wednesday had 200, and now we're at 86. We still have a lot of stocks in the Perfect Speculator pre-scan, 98, and the regular Perfect Speculator scan, 62, but it's still well off the highs. But the most obvious thing is that my own personal individual long scan that looks for price volume BOP surges, each day it's just getting worse. And for instance, these could be long positions for somebody, but on Friday, the only 3 stocks that looked good to me were all 3 insurance stocks. UVE, nice little breakout, but that's not a hot chart pattern, like technical pattern. Like there's not a lot of green in that. THG, the same thing, not a lot of green in that. FNF, nice breakout, same thing, not a lot of green in that. But you can see these 3 stocks, they're bucking the trend, but that's in the insurance sector, so not too good. The rest of it, the breadth is pretty bad out there. My Can Slim scans are the highest quality stocks. Way more stocks down than stocks up every day the past week and last Friday. And it just is not looking healthy overall. So not only are the charts now looking bad, breadth looking bad, but also this earnings season, I was kind of thinking that maybe the weakness was due to earnings overall. But look at even the last time Amazon has gapped up both times. Like, look at this last time it gapped up. As soon as Amazon gapped up, it just continued to rally higher and then pulled back lightly and then moved higher. And then boom, it gaps up again. And notice that on its first day, it still, while it doesn't close near the highs, closes above where it opened. And then it pulls back on lighter trade. Now notice on Friday, Amazon gapped up and then just spent the rest of the session selling off. Still closing up 9% on the day. We still have a very large gain in our personal holding, but this huge intraday reversal out of Amazon is out of characteristic. And look at Google. After Google gapped up 16% on the 17th, it has just completely shit the bed, fallen apart, and it has completely basically rolled over on heavier volume each session. I mean, volume's been extremely heavy on Google. Apple gapped down and it's rallied off its initial lows, but it isn't gaining any traction above the 50-day moving average. So we've got some adverse price action that we're not used to seeing. And normally during earnings season, during the pre-market, we look for an earnings winner, which means any stock that gaps up huge following earnings release on huge volume, and we look to play the intraday breakouts. Intraday breakouts on these smaller cap stocks are reversing immediately and or are not happening or their late day breakouts are not following through the next day. This is a huge change in character this earnings season compared to last earnings season. And then let's get into the commodities. The commodities are breaking to new lows after already being in a 3+ year downtrend. Commodities topped out in 2011, and they've been bouncing off the 2015 lows for months now, but we're rolling over harshly here, and we're hitting new lows in the commodity index. And we had gold break down to even new lows this week. Oil is breaking down to new lows again. So that tells me that the world economy is slowing. When commodities are selling off, transportation stocks that move the commodities are selling off, revenues are declining, and basically all these corporations are beating on the top line with earnings by doing share buyback, which increases the earnings per share and reduces your price to earnings ratio. So there's a lot of financial gimmickry that's starting to become obvious. And then let's not forget, the Federal Reserve is going to start hiking interest rates. It's not ever historically a good time for markets whenever they're hiking interest rates. And then also, let's not forget that we're about ready to enter August and September. August and September since 1950 are the two worst months for the stock market. And going back to 1929, August is the third worst month. February is the second worst month, and September is the first worst month. So seasonally, we're going into the absolute worst time for the market, and we have everything lining up that says that we need to really be defensive. So it should be no surprise that on Friday we had sell signals, full sells in WSBF. Shockingly, and proving that we're probably near done with this market, GIMO. This is a long-term winner with almost nothing wrong with the chart pattern until this Friday, and it's such a harsh hit that it's basically full sell. We'll be leaving the last of our position with a 40% gain, but if it moves below 26.18, this pattern is completely broken. It could bounce, but yeah, I would rather wait for this stock to reset back up than just stay long this stock. But then also SPR rolling over fail, HDS fail, INTL long-term rollover fail, and PGTI fail. VDSI, a longer-term winning, is trying to, but will be using the low a day to get out of the rest of the position of 722. But the bottom line, this character's changed dramatically, which then leads me to my biggest regret on Friday. As you will see in the new longs, new position section, I flagged SRTY. SRTY is a Russell 2000 short hedge, basically, and I picked to go long these stocks instead of going short like the URTY, for instance. So SRTY, pocket pivot point buy signal. I initially enter my 5% order, and then I'm like, you know what? I don't think that it's symmetrical enough to the overall pattern. You know, it seems like it might be a little too early because we still haven't broken out above the short-term downtrend line if I connect the January to May to July highs. So it might be early. The point is, though, it's a pocket pivot point signal in a market that we know rolling over. Not only have I everything that I mentioned, but let's not forget the rising inventory. A telltale sign that an economy is about to get really bad is when companies start announcing that their inventories are rising. So I forgot to mention that. We've been talking about that for months in our chat room, and now it's finally coming to fruition on the price level, so now I give a damn about it. But the rising inventory levels and everything. So I've got all these things that tell me I should take my hedge signal, but I canceled the order because I didn't think it was symmetrical enough off the SRTY move. And of course on Friday it's up 5% in one day, and now it's up too much for me to buy. So since I screwed up and missed it, I'm going to hope that the market wants to rally a little bit, and I'll be putting a 5% limit order at 25.45. If it gets hit, awesome. It probably won't, no big deal. But the good news is also on Friday I have another hedge signal, and I am taking this one. TECS, TEX, it's a Direxion technology bear 3 times. So some big potential gains can come from this if we really enter a downtrending market, because this one is leveraged to the T. But anyway, it's giving me a pocket pivot point signal off its recent support levels. Huge volume surge. BOP has already been green for at least 20 days, and it's surging nicely on the day on Friday. The first sell stop, I don't risk much if I'm wrong, so it's cool. We can cut our losses fast below 36.14. But then the next sell stop won't be all the way to 34.16, and while that's far away, that's kind of good because I kind of want the market to back and fill. Maybe it gets me SRTY. Maybe we get another signal in this one and get some other signals in some other inverse ETFs. And it'll allow me to get my SRTY long. But even if it backs and fills, I want to make sure I have a hedge position once again going into the 2 worst months of the year. It's time to buckle up and take it easy, everyone.